All right, so IBM got absolutely crushed. And when I say crushed, I mean this was not your normal little earnings dip or anything like that. IBM was down around 25% yesterday after releasing preliminary second quarter numbers early. Um, this is before their fully scheduled earnings release. Now, my first reaction is probably the same reaction a lot of people had is, this is IBM, this is not some tiny speculative company with no earnings, no cash flow, no history. This is one of the original blue chip technology companies. This company helped build the internet, build the computer industry. So when a computer a company like IBM loses roughly a quarter of its market value in one day, I don't just say, well, that's bad and move on. I want to understand what actually happened. Was this an overreaction or is this a warning sign? Uh, was management caught flat footed or was the market telling us something that IBM's business story might have changed or something more than investors realized? That's what this video is about. This is not a buy recommendation, not IBM is down, so go buy it. Although it might have worked out a little bit for you if you bought it yet today, a little bit. But this is a video that I want to show about how even the big companies being down 25% doesn't necessarily mean it's cheap. It only means that the market's changed its expectations. So our job is to figure out whether that expectation um, reset created opportunity or revealed the bigger problem. So just a source note here: IBM released selected preliminary Q2 26 results July 14th and said final results may differ slightly as the company was still closing this quarter. So IBM investors page, this is where we got this information from. It's a formal Q2 earnings announcement for July 22nd is what we're expecting. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. All right, so why did IBM fall so hard? Really, the simple answer is IBM pre released disappointing second quarter numbers. I mean, that's really about it. IBM said the preliminary revenue was 17.2 billion, which was only up 1% year over year. That's not very good for IBM, and then investors weren't happy about it. Analysts' expectations were 17.86, and they also their earnings came in at $2.93 a share, and analysts were looking at 301. So they missed on both accounts. But honestly, the numbers aren't the whole story. Really, the bigger issue is the explanation that they gave. So IBM said customers were shifting spending towards servers, storage, and memory, basically the physical infrastructure needed for AI. That hurt part of IBM software and infrastructure business, right? So uh, AI can help companies while hurt others, right? Um, so the money doesn't necessarily magically expand everywhere. Sometimes customers have a budget, and when they're spending more on memory or servers and chips, data center infrastructure, that money may not go into software or consulting at the same pace. So IBM said several large deals did not close as expected. That's going to matter because when a company's missing earnings, investors ask, well, was this just timing or did the business lose momentum? So that's why IBM got punished so hard. It's not just the miss. It was the fear that AI spending cycle may be shifting money away from IBM's higher margin software and service story. Before we decide whether this is an opportunity or a warning sign, we have to understand what IBM actually does. IBM's not just old computers, that is lazy analysis. IBM today is an enterprise technology company. It's got software, consulting, infrastructure, hybrid cloud, AI tools, mainframes, and it has Red Hat. And it has a deep relationship with large companies, governments, bank issuers, insurers, and a lot of enterprise customers as well. So that matters because big enterprises don't usually rip out their core systems overnight. IBM has a moat and in certain areas because these systems are complicated. They're real sticky. Then they're also usually mission critical. So you have here on one side, being important doesn't mean that you're not growing fast. Being old doesn't mean you're safe either. Having a strong brand does not necessarily mean that investors are going to ignore weak execution. So, okay, here's my question then: is IBM a famous company? Of course it is. That's a question, but the question should be: can the portfolio still grow, produce cash flow, protect margins, stay relevant as AI changes and how customers are spending their money? That's honestly the real question. So this is probably the most important slide in my video. AI spending does not help every tech company equally. That's the mistake people are making. So they hear AI boom and assume every technology company should benefit, right? So, but that's not how budgets work, right? A company may not only have so much to spend, and right now AI is forcing companies to spend heavily on physical infrastructure like servers, storage, memory, cybersecurity, data center capacity, power, cooling. A lot of the companies that we've been talking about over the last uh, my last 5 or 6 videos, that can help companies tied to chip, memory, data centers, power equipment, and infrastructure, but it can create pressure somewhere else. Software budgets can get delayed. Consulting projects can slip, large transformation deals can get pushed back. So the legacy AI priorities can change, right? So this is why this IBM video fits perfectly after my GE Vernova, Vertiv, and my AIPO videos. GE Vernova was about the power and grid, and Vertiv, of course, is the cooling. The AIPO was the basket approach. If you listen to my other videos, IBM's on the other side of this, right? It could be AI could be bullish for infrastructure and still be have a lot of pressure on software and services. That doesn't mean that IBM is broken. It just means that investors have to take the warning seriously, right? Because when budgets shift, winners and losers can change. I see it every day. Um, Routers framed IBM's warning as a sign that AI driven infrastructure spending may be squeezing software budgets. While AP reported IBM explanations around customers' front loader servers, storage, and memory purchases can be squeezed as well. So, what we're looking at is these AI plays are moving in and out of each other as far as the money. The money's moving from IBM to GE Vernova to Vertiv or Nvidia, the chips. It's just constantly moving, and it's makes it a lot more difficult. But it also means that when you get a bad earnings, it can get hit real hard, real fast. All right, let's look at some actual business evidence, right? IBM said preliminary second quarter revenue was about 17.2 billion or up about 1% from last year. Software revenue was up 5%. Consulting revenue was kind of flat or up about 1% at constraint currency. Infrastructure revenue was down 7%. GAAP diluted earnings per share were $2.27. That was down 2%. Operating earnings per share was 293, which was up 5%. Year to date free cash flow 4.8 billion. GAAP gross margin was 57.7. This was down 100 basis points. Operating gross margins 59.4%, down 70 basis points. So this is not a company with no business. This is not a zero, if you will, right? I mean, IBM is still generating revenue, it's still producing cash flow, the software is still growing, but the problem is the expectations were high. We had a big run up, and when investors are paying for stability, like software growth and AI relevance and cash flow, even a modest miss can get punished in this market right now. So that's why I don't want to oversimplify this. The bulls can say, well, cash flow is still real, but the bears can say growth is too weak, infrastructure missed, margins were pressured, and management missed the shift. Both sides have a point. This is why it's not an automatic buy. It's worth doing some research here. So this is my little personal touch I put on these. Let's run IBM through my 7 fundamental principles. So this is not a rating. This is a framework. So number one, growth. Right now, I would say maybe revenue growed slowly to 1%. Um, but the software was still positive. So number two, moat. This is my number one area that I look at, and I would say yes. IBM has an enterprise relationships, mainframe depth, switching costs, Red Hat, and long-standing customer relationships. So number three is my management. All right, I'm gonna give management a maybe. And to management's credit, they came out early and owned this mess, but the execution has to prove itself. So number four, margins. I would say maybe. Margins are still strong in absolute terms, but gross margin pressure is a watch item. So keep that in mind. Number five, cash flow. Definitely a yes. I mean, year to date cash flow 4.8 billion is a major support, right? So number six is risk. I wouldn't. I'm going to say maybe to no right now. Not because IBM is going bankrupt or anything ridiculous like that. It's just because the risk clearly increased. The AI budget shift, deal timing, software pressure, consulting softness, infrastructure weakness. These all matter to me. And there's a question there. And number seven is my timing. Again, I'm going to go with maybe. The stock had a huge reset, but I still want stabilization. So my verdict is real business, real cash flow, definitely a real moat, but also real questions, right? And this is why I'm not going to blindly buy this dip situation here. Let's see what happens. All right, so let's make a bull case because there is one. IBM still has cash flow. Year to date free cash was 4.8 billion. I mean, that matters for a company that income investors often care about, right? IBM still has a dividend angle. The dividend alone is not enough to make me buy a stock, but I mean, if there's free cash flow holds up and investors are going to pay attention, right? So IBM still has Red Hat. The company said that Red Hat revenue is going to accelerate sequentially to 11%. So IBM still has hybrid cloud exposure. A lot of that large enterprises are not going to run for their uh, to change their enterprise business on a simple system. Uh, they have a complex environment, legacy systems and cloud systems, security needs, and modernization products. So IBM still has enterprise customer relationships. This is not something that a competitor can just build overnight. The stock had a major valuation reset. Now, I want to be careful here. A 25% drop does not automatically make IBM cheap, but it does make the expectation. It just means that expectations changed, right? Um, And sometimes when expectations reset too aggressively, opportunity can appear. So the bull case is not IBM down, so buy it. The bull case is if free cash flow holds up, if Red Hat keeps growing, if the AI budget shift is just temporary, and if management can get their act together, this could be just an overreaction. That's a reasonable thesis, but I still need a little bit of proof on it. All right, so here's my risk case. Everybody knows how this works, because this part matters just as much. So the first risk is software budget pressure. If customers are redirecting their spending towards AI infrastructure, IBM software growth can remain under pressure. Right? I mean, the second risk is the consulting softness. Consulting revenue is flat. If big enterprise customers slow down this transformational work, that can weigh a bit on the IBM's growth story, right? So the third risk is the infrastructure cyclicality. Mainframe and infrastructure cycles can be a bit lumpy, and IBM's infrastructure revenue was down 7%. So the fourth risk is the deal execution, like I was talking about with their management. IBM said several of these large deals didn't close the way they expected or on time. Now, that's not something investors can just ignore. The fifth risk is the margin pressure. Gross margins move lower in the preliminary results. The sixth risk would be like kind of a value trap risk, honestly. And that's important because a stock can look cheap after a big drop, especially a famous brand, one that pays a dividend. It could still have a value trap, even if the business you know, isn't deteriorating or is deteriorating faster than the price reflects. Now, I'm not saying IBM's a value trap. I'm not saying that. What I'm saying is that risk. We have to test it. This is where discipline's going to matter for all of us, right? A big drop doesn't mean an automatic bargain. It just means the homework just got more important, really. All right, now here's the way I think about this as far as my action plan. This is not financial advice. This is my framework. IBM traded around $217 after the drop, with an intraday low around 213 on July 14th, 2026. So the first thing I'm watching for is like the panic low area. For me, that's going to be roughly around 213 to I don't know, between 210 and 220. I know it's a big area, but that's kind of the area I'll be looking at. I don't see us getting below 210 right away. There's quite a bit of looks like quite a bit of buying pressure right around that 210 mark. So I don't see that dropping down that far. So I want to see whether buyers defend that area. The next zone is the stabilization zone for me. That's going to be roughly around that 225 to 230 area. If IBM starts building a base or higher low, that becomes more interesting, right? Then I want confirmation, not just a 1 day bounce, not just a dead cat bounce. I want evidence that the selling is calming down and that the stand down zone is simple. If IBM breaks the panic low uh, and cannot stabilize, patience is going to win. No hero trade, no it's got to bounce kind of situation. No praying, no oversized positions just because the stock's down. For income investors, cash secured puts might be something to study. But if you're truly want to own IBM shares at the strike price, the dividend is not enough by itself, in my opinion. The business has to justify the risk. So my plan is to wait, watch. I want to see the panic settle a little bit, study that final Q2 report, watch management's commentary, and I want to watch the software, consulting, infrastructure, margins. I want to watch the free cash flow. The only and then only then really is when I'm going to decide, is this a buyable overreaction, or if this was a real warning. So here's the practical income investing takeaway. IBM getting crushed 25% down is a big deal. And my first instinct is the same as a lot of investors. How does this blue chip company lose that much value in one day? But the answer is because the market was not reacting to just one thing, it was reacting to possible story change. IBM was supposed to be stable. It was supposed to be the AI hybrid cloud cash flow name. Then management came out early and said, well, we missed. The infrastructure was weak, consulting was flat, some deals got missed. Customers shifted spending towards server storage and memory. Well, AI infrastructure spending may be squeezing other tech budgets, and that might be why the stock got hit so hard. It doesn't mean that IBM's broken. No, it doesn't mean that. But does it mean it's automatically cheap? Also, no. It means IBM's worth researching, but only with discipline. For me, a bigger question would be, is the stock stable? Is the cash flow holding up? Does Red Hat keep growing? Does consulting improve? Does the infrastructure recover? And does management prove that it's not crazy? If the management's the problem, then there's a bigger problem with this business, and it's happened. I don't care how big the stock is. It's just this is part of it. So that's the difference between opportunity and warning. A big drop can create opportunity, but only after some homework. Before I wrap up, I want to show you one of the things I'm sharing with you all for free is my screenshotable IBM company snapshot is going to be on the screen at the end of this video. So pause the video, save it. You can use this as a research point. These snapshots are really helpful to me, and I've been told that these are very helpful for people that look at them. So, do you think IBM's a buyable dip, or do you think the market's warning us? This is practical income investing on my radar. Worth researching. This is not financial advice. Thanks for watching. Hit the like, subscribe. You know the story. I really appreciate you all. Till next time.